smart procurement and global trade insights.
Hey everyone! Welcome back to Smart Procurement. Always great to have you here. Today we're talking about CIP, Carriage and Insurance Paid To. Now, if you've watched my CIP video, you'll notice some similarities, but CIP is like the upgraded, more flexible version. So let's break it down together. Nice and easy. Okay, let's look under the hood. CIP stands for Carriage and Insurance Paid To. Now, on paper, it sounds simple. The seller handles the ride and the insurance all the way to the destination. But here's the kicker, and this is the part where most procurement teams trip up. The risk actually jumps ship way earlier. The second those goods are handed over to the first carrier, that risk is on you, the buyer. The seller is paying for the journey, but you're the one holding the risk during it. Seller versus buyer responsibilities. Think of the seller's job like a premium service. They handle the export paperwork, the customs, the freight, and this is the big win for you, the ICCA insurance. That's the gold standard of coverage. But once those goods hit that first carrier, the baton passes to you. You own the risk from there, and you're responsible for the import taxes and that final leg of the journey to your warehouse. CIP versus CIF, the battle comparison. If you're looking at these two and wondering which to pick, here's the cheat sheet. CIF is strictly for the sea. It's old school. CIP, it's modern. It works for air, road, rail, and containers. Plus, CIF only requires minimum insurance, while CIP demands maximum coverage. If you want better protection, CIP is your winner. Okay, guys, now let's talk about the buyer side under CIP, because this is where many people get surprised. First thing, risk. Even though the seller is paying for transport and even paying for full insurance, the risk actually becomes yours the moment the goods are handed over to the first carrier. So the truck picks it up from the seller's warehouse, or the airline receives it at the airport. From that second onward, if something happens, it's technically your risk. Yes, you're insured, but still, it's your risk. Second, import customs. Once the shipment reaches your country, the seller is done. You are the one who has to deal with customs clearance. That means paperwork, HS codes, approvals, inspections, brokers, all of that fun stuff. If customs holds the cargo, that's on you, not on the seller. Third, duties and taxes. No free lunch here. All import duties. VAT, customs fees, port charges on the import side. Those are fully the buyer's responsibility. CIP doesn't mean all-inclusive to your warehouse. It only means the seller pays transport and insurance, not government money. And finally, local delivery after arrival. Once the goods reach the agreed destination point, say the airport, seaport, or inland terminal, the last mile is yours. Trucking to your warehouse, handling, storage, demurrage if you're late. That's all on the buyer. So, in simple words, under CIP, the seller pays for the journey and protects it with full insurance. But you, the buyer, carry the risk from the first carrier, you deal with customs, you pay the taxes, and you take care of everything from arrival to your door. Now, let's quickly compare CIP and CIF, because these two are like cousins and people mix them up all the time. First difference, transport mode. CIP works with anything, truck, plane, ship, train, or all of them together. Multimodal, door-to-door, no problem. CIF, on the other hand, is old school. It's basically for sea transport only. Think bulk cargo, vessels, ports. Second, insurance. With CIP, the seller must give you full insurance, the good stuff, ICCA, real protection. With CIF, the seller only has to provide minimum insurance, ICCC. It's more like basic survival cover. Third, risk transfer. Under CIP, the risk moves to the buyer when the goods are handed to the first carrier. The moment the first truck or airline takes over, the risk is already yours. Under CIF, The risk transfers later, when the goods are loaded on board the vessel at a port of origin. And finally, what each one is best for. CIP is perfect for containers, air freight and multimodal shipments, basically modern supply chains. CIF fits better with bulk cargo moving by sea, like grain, oil or raw materials. So the simple way to remember it is this. CIP is the modern, flexible, better insured version. CIF is the traditional, sea-only, minimum insurance version. Alright, now let's bust some of the most common mistakes people make with CIP. And trust me, I see these all the time in real projects. Mistake number 1. People assume the seller carries the risk all the way until the goods arrive. They think, hey, the seller is paying for transport and insurance, so if something happens in transit, it's on them. Wrong. Under CIP, the risk moves to the buyer the moment the goods are handed to the first carrier. The seller is paying, yes, but the risk is already yours. Mistake number 2. Not checking the insurance coverage. Everyone hears full insurance and relaxes. But do you actually ask for the insurance certificate? Do you verify that it's ICCA and not some downgraded cover? Many buyers don't. And when something goes wrong, that's when the headache starts. Mistake number 3. Using CIP for sea-only shipments without thinking. CIP works for sea, yes, but it's really designed for multimodal and containerized transport. If your shipment is pure bulk by vessel, sometimes CIF fits better. Choosing CIP just because it sounds safer without matching it to the transport mode is a classic mistake. Mistake number 4. Confusing CIP with CIF. They sound similar. They both include insurance, and both mean the seller pays freight. But the rules are different. The level of insurance is different. The risk transfer point is different. And the suitable transport modes are different. Mixing them up can mean you think you're protected, when you're not. So the big takeaway, with Incoterms, especially CIP and CIF, one wrong assumption can change who carries the risk, who pays when something goes wrong, and who ends up in trouble. Now the big question, when should you actually use CIP? First, use CIP when you want a predictable landed cost. You want the seller to take care of the main transport and the insurance, so you're not chasing freight forwarders, negotiating rates, or worrying about insurance premiums. You just agree on the destination, and the seller builds all that into the price. Simple and clean. Second, when you want the seller to arrange the insurance, instead of you calling insurers, checking clauses, and buying coverage, the seller does it for you, and not the cheap version. Under CIP, it has to be full cover, ICCA, so you're protected against most risks during the journey. Third, when you're shipping containers or using more than one mode of transport. Truck to port, ship to another country, then train or truck again. That's exactly what CIP was made for. It fits modern, door-to-door, multimodal supply chains much better than old sea-only terms. And finally, when you need maximum insurance coverage, high-value goods, sensitive equipment, electronics, pharmaceuticals, anything where damage or loss would really hurt. CIP gives you the strongest insurance obligation from the seller side. So if you want simplicity, full insurance, and flexibility across transport modes, CIP is usually a very smart choice. So here's the bottom line, guys. If you're in procurement and you're still mixing up CIP and CIF, you're not just mixing up letters, you're mixing up risk, insurance, and real money. And that means you're literally leaving money on the table and exposing yourself to risks you don't even realize you're carrying. Once you really understand the difference, you start making smarter contract decisions, you negotiate better, and you protect your company a lot more. So if you want more simple, practical explanations like this, no textbook language, just real-life procurement clarity. Hit subscribe and let's keep learning together.